Welcome to Michigan Reimagined, presented by T.A. Forsberg and Waggoner Financial. And here's your host, Chris Buck.
So whether you're an individual or a business owner, having a sound investment strategy is critical when it comes to meeting your financial goals, whatever they may be. Here to discuss their proprietary stock selection strategy called RFED or RFED. I'll let you guys elaborate on this, are the members of the Waggoner Financial team, the founder, Mr. Eric Waggoner, junior portfolio manager, Shanzer Khan, and investment analyst, Mark Hu. Welcome to the show, gentlemen.
Great to be here.
Pleasure to be here.
Excellent. So let's start by elaborating on my intro. Who should be listening closely about what we're about to discuss? Like, who's your target audience? Who should be pricking up and just say, I'm going to learn something good here?
Well, I think everybody should know at least a little about stocks and capital markets, and anyone that wants to retire someday needs to make sure that they have a portfolio of stocks. So that's the way it's generally done. So I think that anybody who has who eventually wants to live off of their assets should be tuning in.
Right. And even if you don't want to know all of the details on how to do it, you want to build trust with someone that you believe knows how to do it.
You can either do it yourself or you can outsource it. Yeah.
Makes sense. Okay. And you believe that the traditional method for categorizing stock as growth or income, is antiquated, right? It seems like this whole process that you've created proprietarily is to replace what you deem to be kind of an older model. Is that true?
That's partially true. Antiquated is one way to put it. I think that, there are things that were done well, but they just weren't enough. So I would say that our system augments what's already been in place.
Got it.
Yeah.
Okay. And you've been hearing from, this is Eric Waggoner, the principal and founder for Waggoner Financial. Shanzer, why don't you just talk a little bit about your role within the organization? What role do you play with the team?
Yeah. So as you mentioned in the beginning, I'm the junior portfolio manager on the team. What I do is make sure that our research systems, our portfolio management techniques, and whatnot lead to optimal outcomes for our clients. I try to make sure that, hey, the design of the portfolio is sound. If you're taking advantage of business cycles, it's in the right positioning at this time. That's in a nutshell what I try to do. But there's a lot that we do pretty much on a daily basis. We meet with clients. We like to know our community. We engage with them. We work on the investment stuff together too. We like to keep clients intertwined with what we try to do. So there's a lot we do, but in a nutshell, that's what I do for the firm. Yeah.
Excellent. And Mark, what's your role within Waggoner Financial?
Yeah, so my role is mostly on equity research, but on RFED, like Eric just talked about, it's antiquated because RFED is really an extension of factor investing. And a lot of these factors that has been discovered in the past might not work in the future. So a lot of them has been, their excess return or alpha, if you will, has been traded away. So this proprietary way that we find to segment the market, I'm kind of the lead person to test it out, to see if these factors will work for us in the future and provide us with an elusive edge.
And at the end of the day, your job is never done. Because everything, you can't fix it and then just let it ride. There's always market implications and things that are changing, right?
Constantly innovating. Even this morning, we were having innovative discussions, and with the market, you kind of have to roll with the punches. You got to go with the flow. Yeah.
Someone, maybe it was you, Eric, but talked about financial planning as kind of sailing a boat. Sometimes you need to move the rudder a little bit. You got to pull the sail a little tighter. You got to let it out a little bit. You got to turn it this way. You got to turn it that way. It's like you don't just point it and go.
Exactly.
Like, you always have to be adjusting to whichever way the wind's blowing and make your vessel as fluid as it can be. That's fantastic. So what I love about Waggoner Financial is not only are you really, really good at what you do and have this kind of vision for the right way to really advocate for your clients' well-being, but you can feel the entrepreneur, small business nimbleness, right? I mean, there are a lot of different financial institutions that you can go that have bigger, broader names, global reach, and all that kind of stuff. But it seems like there's a box and they're in it, and maybe they'll have a couple people that can take you out of it. Maybe that's not even fair. But what I love about the energy is just, you guys get your hands dirty and really kind of figure it out and deploy stuff that works. And I also see the real and the metaphoric high fives on successes and banging your head against the wall when something doesn't pan out. But that ownership really resonates, which I like so much.
I'm glad you caught that. That I realized early on that you don't have the opportunity to work with the best people unless you are growing. And you're green and growing. So it's, a lot of financial firms or financial advisors, I noticed when I started in the career, they would become successful. But after that, it was kind of like a now what moment. What do I do with the rest of my life? Do I just golf? For the rest of my life, I've got a certain number of clients, and they can sustain our business. And I've got a couple of administrative people that work with me. But it was like, what's next? And that wasn't very appealing to me. I wanted to work with the best and the brightest. I feel like I do, and it's just certainly a pleasure to have that opportunity. But that's the pro. The con is that we've always got to be growing. We always have that. We always feel like we're racing against the clock, and we have to do something newer and bigger and better. So.
Right on. Okay. Well, we've talked about RFED. Do we say RFED? It's not just 4 letters, right? So RFED is a trademarked strategy. So someone share with me, what does RFED stand for?
Well, I'll start with that. RFED is ARFED, and what it stands for is it's our stock classification system. And so I think that when we talked earlier about it being an extension to factor investing or augmenting a system which was already in place, the best way to think about RFED is that there are certain stocks that pay dividends. Okay. A dividend is, when a company is profitable, they take some of the profits and they share it. And so if you own that stock, just like any business, they share the profit. The company will share the profits with you, and you get paid a dividend.
So it's not just the growth. If it was trading at 20 and now it's trading at 28. They will actually also distribute cash as a dividend.
Great. Yeah. I mean, that's a common misconception in stocks. The company may not be growing at all, but as long as they're paying you a dividend, you are growing.
Right. Okay.
And so there are pretty well accepted mathematical techniques, the Gordon growth model, the dividend discount model. There are accepted techniques for valuing companies that are steady and consistent in their dividend payments. And so I think most people that participate in stocks are familiar with dividend stocks or dividend-paying stocks. But then the question is, what happens? There are plenty of companies out there that don't pay dividends. They don't pay dividends at all. Berkshire Hathaway is an example. So an example of a dividend stock would be, Chevron.
Okay.
Or Verizon.
Or Verizon. Yeah, Verizon's a better example. And but there are some companies that don't pay a dividend. So if they don't pay a dividend, what does that mean? Are they worthless? Clearly, they're not. An example of that would be Berkshire Hathaway. They don't pay a dividend at all, but that doesn't mean they're worthless. So if a company does not pay a dividend and there's not some well-accepted technique for valuing that company, then how do you value them then? I mean, what's the market? How is the market determining a price for that company? So we would call Berkshire Hathaway an earnings stock because we feel that the market and market participants tend to value that stock based on its earnings cash flows. Some companies don't have earnings at all, but they're still worth something. And so those companies might be like Duolingo. They might have Duolingo is basically it was an iPhone app of the year, I think, 10 years ago. And the company is growing sales at 40%, but they recently just became profitable. They don't have earnings. You can't value them based on their earnings cash flow. So what do you do then? We would call that company an earnings stock, or a free cash flow stock. And we feel like the market tends to categorize or value that stock based on its free cash flows. And then there are some companies like DraftKings, they don't even have free cash flow. They're losing money.
Okay.
But they're growing sales, and they're losing money on purpose. And so how do you value a company that's losing money on purpose? They're still growing. I mean, the price is still going up. The market cap's still going up. And we would call DraftKings a revenue stock because we feel like the market looks at its revenues and determines and then the last category would be asset class. There are some companies that don't even sell anything. Mm-hmm. Virgin Galactic was a company like that a couple of years ago. They don't sell anything, but they're still worth something. And so we would call those assets, we would put them in the asset category, that there's some sort of future cash flow on which they're valued.
So as an investor, how much am I or should I be motivated by dividends versus just the growth of my money in a company that is growing, right? I mean, I think the layperson would probably tell you, hey, someone help me deploy, $50,000 into a company that's trading at $10. 5 years later, it's trading at $18. 30 years later, it splits and now I've got double the shares, but now it's back down to 12 or whatever. And it just grows and grows and grows and grows. So my position in that company is just a mathematical, how many shares do I have and what's it trading on? And that's cash that I can deploy with tax consequences and all that kind of stuff. So, but then dividends is you're obviously tracking the performance of the company, and that same model still applies. But dividends give me money that I can either use to spend in my day-to-day living or reinvest into that same company and buy more shares or to other companies. Why is there a better advantage to dividends, or is there? You know, we're talking about dividend stocks and non-dividend stocks, but what should I be motivated by a dividend stock differently than others, or is it just dependent on my goals?
Yeah, so what kind of stocks you should buy or you should own really depends on what you're looking for out of your investments. So, and I'll kick this to Mark and Shanzer here in a second, but a company that's paying consistent dividends tends to be buoyant. It's what I call buoyant. So imagine trying to hold a beach ball underwater.
Yep.
I mean, if a company, we recently saw this with a company called 3M. 3M pays a dividend and its dividend yield was quite high, but clearly when a company is paying a consistent dividend, but the market is still valuing that company very, very low, then the market clearly expects something to go wrong. And if nothing does go wrong, then that company can, boom, just pop up right out of the water like a beach ball, right?
Yep.
So companies that pay dividends are typically pretty buoyant, but just like a beach ball, you know, when it pops out of the water, it doesn't go very high either. I mean, you know, a beach ball can't be held under and it doesn't go very high either. I mean, the dividends are really going to peg, for those types of stocks, the dividends are really going to peg the value of a stock pretty well. So what types of stocks you should own? If you want to make 400% or 500% a stock, that is possible. There are stocks that do that. I can't tell you which ones are going to do that. I wish I could, but that's probably not going to happen anytime soon for a company that's a mature company paying a dividend. So if you're looking for steady, consistent growth, then a dividend stock might be for you. If you're looking for something that has the possibility that could possibly quadruple in value, then you're going to want to look at something that is much riskier and is much more difficult to value by the market. And those would be the revenue and free cash flow stocks.
And just to add to that,
please, yes.
I was just going to add to that. Like Eric is mentioning all these items which make perfect, like in the sense of RFED, they make total sense, and it's assuming normal investment conditions. The thing about RFED is not just the stocks themselves and the characteristics associated with them, it's also the environment that you're in. So as an investor, when you ask that question, obviously we will sit down with you and look at your objectives, we'll understand you better, what your risk profile is and whatnot. That's above all before we even start designing the investment strategy. But then we also, as investment specialists, we want to look at the environment we're in. So as an example, in 2022, we had an environment where the market, or the broader market with the S&P 500, which the S&P 500 is what people commonly use to track the broader market indices.
Yep.
When it was down, people were thinking what we should buy. So in that environment, dividend stocks were thriving. So our dividend index, without mentioning any particular items in detail, our portfolio or our index didn't lose any money during that time. It didn't lose any value during a broader market pull down. So what I'm trying to say from here is that the environment also matters. Like how we want to position you would also depend on the business cycle we're in, how the environment is responding to certain those particular cash flows or those companies in those classes. So it's a lot more nuanced. But yeah, I was just adding to Eric's point. Yep.
Yeah, each category of stock is going to behave very differently based on the macroeconomic factors that go into it. That sounds like a lot of hooey, but I mean, interest rates are going to affect one type of stock much more than another type of stock as we view it.
Got it.
Right. And also to kind of add on a little bit to that as well, as Shanzer mentioned, the environment matters, and as Eric mentioned, your style as an investor matters. So RFED kind of pull back. RFED is our way to classify the companies in the market, just like Farmer French did with size, small cap, mid cap, large cap, or growth versus value, like high book to market or low book to market. You won't just pick small cap for your life, right? So
right.
You can't just pick dividend for your life as well, just like that. And our way of segmenting the market using RFED is we look at the cash flows naturally, and that way we believe this way is the way that it aligns more with the company's natural life cycle. Yeah. Right.
Okay. I do want to step aside for 1 second and thank one of our sponsors. We've got Triterra. Triterra is a leading environmental consulting firm headquartered here in Lansing, Michigan, with staff around the state to serve your brownfield development, environmental consulting, and natural resource management needs. Since 2008, Triterra has been successfully advising a wide range of organizations to implement solutions to complex environmental challenges. If you are a business, a developer, a property owner, a lending institution, an attorney, or governmental entity looking for a solution and you want prompt and timely service, don't hesitate to contact my friends at Triterra. Led by CEO and visionary Don McNabb and his leaders JP Buckingham and Dave Van Haren and their amazing support team of technical experts, you can't miss by calling Triterra at 517-702-0470 or check them out at triterra.us. They mean it when they say it's not just what they do, it's how they do it and who they are. Triterra guys. I love those guys. They do fantastic work out there. You were talking through RFED that you've got phases of stock. Is that correct?
Yeah.
So talk about the different phases, and from a layperson standpoint, what do those phases mean?
Well, a company doesn't necessarily just fall into one category as we see it. Sometimes those companies transition backwards or forwards through that classification system. A good example would be Boeing a couple years ago. Boeing used to pay a dividend. They no longer pay a dividend. I think their mishaps are well documented. But so we find that there are a lot of opportunities when stocks move either forward or backward through our classification system. So Boeing was making money. It was a great stock. Now that it's been knocked downward, and the price, I think at one point Boeing was trading at $440 a share. At a later point, it was trading at $97 a share. So at what point do you say, hey, this represents a good value? Maybe it should have gone down, but not down that much. I mean, size matters.
Right.
So we see that, and then also when stocks move forward through our classification, that's natural. So, if I was on here 2 years ago, I would have mentioned most of the Mag 7 stocks as being earnings stocks. They didn't pay dividends, and the Mag 7 would be stocks like Nvidia and Apple and Meta and Google and Amazon. All these, at least 3 or 4 of these Mag 7 stocks have decided to pay dividends in the last year and a half. And so as they mature, they move through that cycle. But sometimes the most interesting thing I think about that is that when a company changes its classification, it often gets, in my view, misvalued pretty badly. And so Apple went from being, back a couple years ago, people would have said Apple was a growth stock, and then later they would have said maybe it's a value stock. Well, in that transition from being a growth to value stock, Apple went down to a price to earnings ratio of 10. And now it's grown 600% since that point. So what happens is as you transition through these categories, you end up seeing what we view as mispricings or undervaluations. There's several examples of that going on in the market right now. And those we feel are good times to step in and buy those stocks. But I'll leave it to some of my
Right. So you guys are the eyes and ears of the ground that do all that analysis to identify what you believe are misvalued stocks and pivot based on obviously putting more into things that you think are undervalued and start maybe releasing some of the stuff that you think is overvalued before the castle topples. Is that right?
Yeah, that's totally right. And there's a fine distinction just to add there, undervalued, overvalued, but there's also premium and discount. Like the market will pay for quality. Like they would pay, like as we see with Microsoft, they've really traded at low multiples, or to Eric's point with Apple, it traded at earnings of 10. But Microsoft, you would probably not catch them so close trading to low earnings multiples. And the thing is, the market rewards quality. And when the quality is there, people let them drift higher because they're more accepting of taking the risk of buying that quality.
Right.
And that leads to higher multiples. So just wanted to add that particular nuance, like not just undervalued or overvalued, it's just also premium and discount. If we play the game of picking, hey, which premium is fair, which is not fair, and we try to take advantage of those mispricings. But when it comes to RFED, to Eric's point, it's just a transitional, like it's a natural cycle. Every company in the beginning when they start, not every company I should say, like a financials does start profitable.
Yep.
So there is a distinction to be made there, but most companies when they start up, they begin with spending a lot because they have to invest, they have to put in money and earn a return on that investment over time. That's the intention. So you start from revenues. As Eric cited a few examples, I'll mention one over here. DraftKings is losing money actively to grow more, to put sales into perspective. Then you have free cash flow stocks, to Eric's point, Duolingo. We have earnings companies in Apple that are trying to not get to that dividend point right away, but they're buying back a lot of stock and trying to rely on earnings growth by driving efficiencies across their businesses. Then we have dividend stocks with Verizon and 3M, and these companies are more mature where we're trying to discount their cash flows back in time and see how valuable they are to us. And we're trying to also see the idiosyncratic risks associated with each company. So in a nutshell, RFED is a natural progression of these companies from revenue to dividends. And what we're trying to do is identify mispricings all through that opportunity. And when it comes to designing the portfolio, which is more in my department, it comes to what's the right mix at this time. And when it comes to the right mix, obviously it depends on different scenarios. So we have different probabilities. As of right now, I'm sure you've heard a lot of the jobs report is popular. A lot of stuff regarding AI is popular. So we want to have probabilities associated with each scenario when we're doing that portfolio management. And between those probabilities, we want to then play our bets. Like, hey, which is mispriced, which is good.
Right. So that leads me to my next question is, what tools do you use to identify all of this? Because listening to you all speak, it's clear that there is an academic component to understanding kind of what the game means and how it is played and kind of macro strategies and lingo and all that kind of stuff. But the difference between a great financial planning organization and someone who is just kind of tinkering around seems to be knowing where to go, like what to read, what to study, what trends to follow, so then you can kind of say, okay, this is my third indicator that this is out of whack and I can actually pounce on that. And that seems to be where the sweet spot is of being good at what you do. Where do you go to see which way the wind is blowing that a guy like me doesn't have time to go figure out?
Well,
unless it's a trade secret.
Well, the first thing I would say is definitely come to us because we're the expert. We've, to your point, the academics, and we've put a lot of work in trying to understand the sweet science or the craft, as most people in the investment world may call it. We're trying to understand the science. We're trying to use the tools that we have at our disposal. And to your point, just to answer that question, we have a lot of tools in the sense that we use Refinitiv or LSEG for a lot of our proprietary research systems when we look at, or a lot of our systems when we're trying to research a stock. And then we have similar applications in there that allow us to design the portfolio. We like to look at correlations between positions, like, hey, how does Apple match Microsoft? How do they move together? So those tools help us understand like how will they behave, and if we know how they behave together, then we can allocate our bets accordingly. So that's one example of a tool. But then we also rely on macroeconomic data, like this, and you have to be very you have to understand that there's hard economic data and soft economic data. Some economic data is not material to a lot of our business decisions when it comes to companies because it may not apply to every single company, but some economic data is very hard, like the unemployment rate. We do feel like that's going to contribute a lot to the broader market. So we want to look at which data is important and which is not. So I hope that helped you with some clarification on like the tools and then also the application, because we're watching the market, but we're also using our tools to signal us like, hey, what do we need to do at this point?
And Mark developed some of those, and I'll let him kind of chat a little bit about it.
Yeah, so before we communicate with the client to choose what style fits you, or before Shanzer kind of see where the wind is blowing and choose what style fits this time, we have to identify what company is in what segment first, right? So for that, we have a lot of screeners for that can identify quantifiable company characteristics to see if is Apple currently a dividend company or a earnings company, or is it just going through the transition? And typically when we think about this, RFED, revenue stocks are typically young growth startups. There are certain characteristics that associate with that. Free cash flow stocks are typically high growth companies that passed the product test already. Earnings companies are in their matured growth stage as their net profit grow quickly and their reinvestment needs kind of shrinks, and dividend companies are mature stable, or maybe mature in their decline, their
sometimes
aging.
Winding down.
Yeah, winding down. Like you can't be scaling up your business model while your business model is obsolete, like Bed Bath & Beyond or Blockbuster.
Yeah.
Right. So these are traits of different classes of RFED, and we have quantifiable company characteristics set in place to help us identify every quarter which company is in which category.
So we'll develop indices that of companies that we feel meet these categories, so we can. It's kind of like a cool contest. I mean, do you fit with these guys, or do you fit? We'll take a company. We'll say, do you fit with this index, or do you fit with this index, or do you fit with these guys or these guys? And the way that we do that is we use some complex mathematical techniques, statistical regressions, multiple regressions, and Mark works on those. We look at the cash flows of the company all the way through, and then that's how we not everyone wants to know how the sauce is made.
Yeah, exactly.
But there's a lot that goes into it.
And honestly speaking, just to add over there, sometimes it might be in a position where we because a lot of investments is subjective, like we're trying to play our bets and our opinions and probabilities. But sometimes we have to rely on the data and the tools to tell us the story. Like we may think that Apple, based on their valuation, based on what they're doing, how traditionally earning stocks have performed, it's an earning stock. But sometimes we may not be sure. So that's where we rely on the regressions or maybe the PCAs or the machine learning techniques we may develop to address that question.
It's a democratic process. We let several different techniques vote, give us their opinion, and that's how we.
The numbers tell the story.
There's an art to it, yeah.
Yep.
Got it. So obviously your goal is to create the most value and wealth for your clients, right? But it was mentioned, someone said, I think it was you, Mark, talked about risk tolerance of the investor. So, it seems logical that if you have a hunch on a handful of companies that you think are going to kind of blow up and get really big, that you want to, your instinct is to put it all in there, but then, all the warnings, kind of say, the past performance is not indicated future, performance, whatever. And you might lose your money. You bet big and you lose, and you lose your wealth. So is it all about the investors telling you about their risk tolerance, or do you assess kind of their phase in life as to, hey, you're young, you've got good income, your costs are in control, I think we go for it. We're going to win a lot more than we lose, but we'll lose a couple here and there. Or, hey, you're 55 and you got 10 more years to work and you want to have a nest egg. So, we'll dabble in I mean, obviously we want everything to be in growth, right? But we're going to be a little bit more conservative on betting your retirement that is imminent on evidence that you have that something's going to really flourish. But gosh, if it doesn't, then I'm going to need to go get that money and it's not going to be there anymore.
I'll kick it over to Mark here in a second, but I wanted to go back to our previous analogy about ships on the ocean.
Yeah.
One of my favorite things about that analogy is that in investing, you never know when the wind is going to blow. You never know for sure, but you have to be prepared. You can't have the sails down when the wind starts blowing or the ship won't move. And you really have to take advantage of your best opportunities. You have to swing at your good pitches. You have to be ready for those pitches when they come. And so I think that when people talk about their risk tolerance, there's a number of things that go into that. But one of the biggest one is, how long can someone afford to wait or is willing to wait on the wind?
Right.
I mean, some of these stocks that don't pay dividends, they can be very volatile, and they're going to be, they're likely going to be really great companies over time, but how long can you wait? How long can you stand to wait? And how much can you watch the ship rock back and forth before you just get tired of it? So I'll kick it to Mark, though.
Yeah. Kind of to build on to that, Chris, you mentioned it as well. It depends on the investor's taste himself, but it also has a lot of conditions that we look at. One very important is investment horizon.
Okay.
How long, like Eric said, how long can you afford to wait? So if you're kind of approaching retirement, but also very risk seeking, you might really like revenue stock, these typical young growth startup companies that are very interesting. We talked about dividend stock, but for revenue stocks, these companies bring disruptive innovation to their industries, but you might have to wait for their inventions, their discoveries, their innovations to work out, like the Apple in the 2000s, Netflix in early 2010s, or perhaps OpenAI currently. Right. So what if your investment horizon doesn't let you wait for that long? And what if it doesn't work out? So we have to help them consider that as well.
Just remembering The Big Short, the movie on the housing stuff. I remember the one scene where Mark, is just like, I may have been early, but I'm not wrong. And it's the same thing. It's same thing. Being early, it can be punishing, but I do have to let it breathe. And honestly, at the end of the day, that's why the average person who's interested in this concept and this conversation and gets what we're talking about, but doesn't have the expertise or the time to do it all themselves. That's why I wanted to make sure we spent time to introduce you, because honestly, household wealth is something that Michigan families need and Lansing families need, and just any strategy that I can help them have to put their money in the right place and have good people manage it is the reason you guys are all here. So,
and no, I was just going to add over here in particular that when it comes to meeting clients and whatnot, a large part of our what we do is educating them and making sure that they understand the risks, they understand what we're trying to do. We tell them their situation. We take all their balance sheet, income statement. We look at everything. We put it down in a nice summarized format. We're like, hey, this is the situation. This situation favors this particular route according to our recommendation, according to our expertise. Now, what do you think? Now, when we work with the clients, we take their preferences into account. Then we're like, okay, let's tailor the strategy a bit, because it seems like you'll sleep better at night if we do this instead.
Right.
So it's not all that we feel like, hey, you should do this definitely, and we're going to go with this. We want to help you, be assured, sleep better at night, knowing that your portfolio is in better hands. And also, we want to educate you to understand what the best approach is when it comes to investments.
So I think an underappreciated aspect of financial planning is that it's our view, and certainly my experience, that investors do better when they're more informed, more educated, and also when they're having more fun.
Right.
You know, an investor that's having more fun will tend to be more engaged. They will save naturally. They'll save more money. And just by virtue of saving, who cares if you get 100% return if you don't have any money in the market or you have very little in the market? So what we want to do is we want to make sure that our clients and our partners, that they're educated, they're informed, and they're having fun.
Right, and that's got to vary quite a bit, because there's got to be a decent amount of people out there in your client base that are probably like me. It's like, let's have some early conversations about risk tolerance and all that kind of stuff. But at the end of the day, I don't want to know. I only care about the performance. I don't need you to call me every 7 or 8 days and say, hey, we got this new idea, and I just wanted your blessings before we move some of your money from here over to here. It's like, no, that's why you're there. Otherwise, I'd do it myself, right? So, but again, that's just my personal, but I do appreciate the getting to know the client, and generally, here's the way we're going to do things. When would you like us to hit pause, pick up the phone, and kind of confirm, if that seems like that's part of your DNA and the way you tend to manage it.
We let the client dictate how much they want to know. And if they want to go, so the analogy I like to use here is that of a restaurant. Most of the time when you go to a restaurant, you just want a really good meal. But you'd also like to know a little bit about their philosophy. Are you using fresh food? Did you cook it all today? Did you do it in-house? If you want to go back into the kitchen, if one of our clients wants to come back into the kitchen with us, they are certainly welcome to do that. Some restaurants will cook your food right in front of you, and that might be part of the experience. Very few people want to see the cow get butchered,
exactly,
but that is also part of the process.
Right.
But they will draw the line somewhere before that. But certainly there's a lot that goes into it, and we're hoping that to follow that analogy, that if the clients just want to sit down and have a delicious meal and a good experience, then they can get that with us.
Well, it's getting late in the conversation. I need to give a nod to my friends at the Forsberg Real Estate Company. When it comes time to creating the best living and working environments for the community, no one does it better than my friends at the Forsberg Real Estate Company. Brent Forsberg and his team create vibrant, holistic communities that inspire growth and encourage belonging. Focused on building stronger connections for people, the Forsberg Project always is in tune with balancing relationships to create the optimum human experience. Since the 1950s, Forsbergs have been enhancing the quality of life in the communities they serve by following the principles of regenerative growth and aligning the resources and tools available. Reach out to my friends at Forsberg Real Estate Company by calling 517-349-9330 or check out their website at lansingrealestate.com. So, we've really beat this up quite a bit. So what else haven't I asked you about RFED and the Waggoner proprietary process to invest on behalf of your clients that you might want to share as we kind of get to the finish line here?
Yeah, I think something to add over here is that when it comes to just RFED, and I think we've talked about the innovation part a bit, but we are working on different items. Like one thing we want to do is, as we explore the asset class that Eric mentioned, we want to try to what Eric mentioned, that some particular companies or some particular demand in the market, because at the end of the day, RFED is a market demand gauger, if that is a word in that particular context. But with asset class, we have people who are buying wheat futures. We have people who are buying oil. We have people buying Bitcoin, that their entire value stems from the underlying asset. So we are right now, as in investing, when it comes to Waggoner, we're trying to innovate into some of these other spaces as well, where we try to invest in futures. If we are trying to predict oil prices, as an example, we do discuss what oil prices mean to our stocks. But now we want to take a step above that, and we want to think about, hey, what do we expect oil to be at? And then buy possibly futures on the oil price, not buy a company. So just something that perhaps you may not know is that we're trying to delve out of the stock strategy as well and try to take advantage of the asset class that I mentioned, which does not necessarily mean stocks. It also means futures, it means derivatives or some other form of asset classes. And yeah, that was another addition I would make over there.
The takeaway that I'd like people to have is that the markets are ever changing. There's always new innovations. Some of the biggest ideas in finance were they were only conceived in the 1970s or the 19. It's a new field. There's always something happening, and if you're someone that's really interested in the markets or gets really excited about new things that are going on, then we are too, and we're your kind of people, and we would love to meet you.
Fantastic. Well, I appreciate you sharing all the information that we have. For those listening, how can people follow along in your story? I know you've got a pretty robust social content and website and things of that nature, newsletters. Talk about that.
Yeah, you can follow me on Twitter or on LinkedIn. I'm sure it should be easy to find. You can go to our website, which is www.waggoner-financial.com. Waggoner spelled with 2 G's, Waggoner. You can call our number at 517-853-3367, or you can enroll in our newsletter, which is called On the Money. It comes out every morning at 9:30 or thereabouts, and my colleagues here put that together. It's a great way for people to stay informed.
Excellent. Well, we've been talking to the Waggoner Financial team, founder Eric Waggoner, junior portfolio manager Shanzer Khan, and the investment analyst Mark Hu. Thank you, gentlemen, for bringing all your intellect to this conversation. I hope our listeners pick something up here and your phones start ringing, because everyone wants to grow their wealth. Appreciate you making it out.
Thanks for having us.
Absolutely. And just a final shout out to all my loyal sponsors. We got Waggoner Real Estate, Waggoner Financial, Forsberg Real Estate, Triterra Environmental, Good Marketing, the attorneys at Foster Swift, Keller Williams Advantage and Team, and our newest sponsor, Michigan Rise, brought to you by the Michigan State University Research Foundation. I want to remind you that you can subscribe and follow Michigan Reimagine on YouTube, Facebook, Apple Podcasts, Google Podcasts, Spotify, and iHeartRadio. Pretty much anywhere you find your podcasts. This is Chris Buck for Michigan Reimagine. Thanks for joining us.